Welcome, my friends. The news today is that Roku stock soared 30% on third quarter revenue beat and a solid outlook. Roku revenue grew 20% year over year in the third quarter and beat Wall Street expectations. Active accounts also beat, coming in at 75.8 million for the quarter. Roku said it experienced a rebound in video ads during the period. So there seems to be life and profitability at least somewhere in the media space. But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school, as well as any kind of job that requires a government license or certification. And ProWorldNet.com also includes short-term gig-type jobs as well. So be sure to check out ProWorldNet.com if you are looking for a job or an employee. Shares of Roku soared Thursday, a day after the company reported better than expected revenue for the third quarter. Here's how Roku performed for the quarter ending September 30, compared to analyst estimates from LSEG, formerly known as Refinitiv. Loss per share, $2.33 vs. $2.12 expected. Revenue, $912 million vs. $855.2 million expected. After the bell Wednesday, Roku reported a net loss of $330.1 million for the third quarter, or $2.33 per share, nearly triple the loss of $122.2 million or 88 cents per share, which is what the company reported in the year-ago quarter. But revenue was up 20% year over year, the company reported, largely driven by strong performance in content distribution and video advertising, along with unit sales of Roku-branded TVs, which launched in March 2023, Roku said in a shareholder letter. Roku-branded smart TVs come pre-installed with the Roku interface users would experience on an external plug-in Roku streaming player. The smart TVs were first made available at Best Buy earlier this year and drove a device segment revenue increase of 33% from the year-ago quarter, the company said during its earnings call Wednesday. Branded TVs also drove a higher portion of net adds in active accounts than the streaming players in international markets, Roku Devices President Mustafa Ozgen said during Wednesday's earnings call. The company said it fared better during the quarter with advertisements, weathering an industry-wide ad slowdown. We had a solid rebound in video ads in the third quarter, Roku Media President Charlie Collier said during the earnings call. We expect year-over-year growth in the fourth quarter to be similar, but we remain cautious about the ad market recovery going forward. Active accounts also beat the Street's estimates, coming in at 75.8 million for the quarter, compared to Street account estimates of 75.33 million. That's a net increase of 2.3 million active accounts from the previous quarter. For the fourth quarter, Roku expects revenue of roughly $955 million, topping the $952 million expected by Wall Street, according to LSEG. In September, Roku said it was laying off 200 employees in a bid to reduce the company's year-over-year operating expense growth rate. The move followed rounds of layoffs earlier this year in March and November 2022. The company also committed to various cost-cutting measures, including consolidating office space and slowing hiring. Media companies are facing several financial challenges. One of the most significant challenges is the rise of streaming services, which has led to a decline in traditional TV viewership and advertising revenue. Streaming providers have been increasing their subscription rates or launching an ad-supported tier to offset the cost of content creation. However, there are concerns about how much money streaming subscribers are willing to pay and how many ads they are willing to tolerate. Another challenge is the high cost of content creation. The amount of dollars invested in content continues to increase, especially when live sports are added to the portfolio. This has led to a situation where some media companies are struggling to generate enough revenue to cover their costs. In addition, media companies are facing increased competition from social media platforms and other digital media outlets. These platforms have disrupted the traditional media business model by offering free content and generating revenue through advertising. This has made it difficult for traditional media companies to compete and generate revenue. One of the most significant challenges is the rise of streaming services, which has led to a decline in traditional TV viewership and advertising revenue. Streaming providers have been increasing their subscription rates or launching an ad-supported tier to offset the cost of content creation. But what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.